Good afternoon and welcome to our workshop for the week starting the 28th of October, the final week's trading in October, which has been a fairly eventful month all in all. We've had the US debt ceiling resolution, albeit in a fairly messy fashion with the brinkmanship that has been going on of late in US politics. It looks as if QE3 tapering is not going to happen, won't happen this year at least, and in fact some commentators suspect that it may not happen until April, as late as April next year. So the drug that is QE3, cheap money, $85 billion worth of purchases by the Fed to inject liquidity into the system, will continue to support equities and perhaps even bonds, although it isn't such a good compelling story with bonds, obviously. So, yes, a very good week generally for equities. The FTSE was up about 100, which is just over 1.5%. The S&P, which is the best performing index in the States, and it's certainly the most closely watched, that was up 14.5 points. That's a little under 1%. The dollar, that's been taking a bit of a hit as well. Certainly last week, the euro stepped up further, another 120 points gain against the dollar, which is just short of 0.9%. British pound, that's a little bit of profit taking there. The British pound against the dollar was unchanged on the week. The yen was marginally stronger versus the dollar, not too much in it. But otherwise, commodities going in different directions, really. We had crude oil was just over $3 weaker on the week, which is 2.7% down. And gold, well, that was completely the other direction. With the weakening dollar, we saw gold rally $35, just a shade of under 2.7%. So quite a diverse, opposite moves there between crude and gold. Although I feel crude perhaps might have overshot a little bit, and we're seeing a little bit of a retracement here this morning. So what was the cause of all of this? Well, below consensus data in the States, non-farm payroll, consumer sentiment, to name but a couple, in the US were below expectations. Non-farm payroll, this was the delayed September data last Tuesday. So it's a little bit sort of out of date, but weaker than expected, weaker than the ADP payroll data that was released at the beginning of October suggested. So not particularly good news for the Fed. Along with the consumer sentiment number last Friday, which is very much a leading indicator that suggests that things are slowing up in the US, and the Fed having been entirely right not to engage in any QE tapering. European data as well, that was pretty weak as well, really. The manufacturing and services sector data out of Europe was less than what was expected, and some underwhelming German IFO business climate survey on Friday as well, so which sort of painted slightly disappointing picture. But the irony is that obviously with poor data, commentators are convinced that QE tapering will not happen, and that's really what's propelled the markets higher. So bad news equals good news, certainly if you're in equities. But in the UK, we've actually had probably the most encouraging data, which was the flash or prelim GDP data for Q3, came in at plus 0.8%, which is another tick for the UK economy. So the government seems to be getting something right, although you wouldn't think so, the way the government is performing, as it were. So here we are for the start of this week, the final week of October. We have not a lot of data out this week, but it's dominated by more employment data. Normally on the first Friday of the new month, which is this Friday, the 1st of November, you would expect to get non-farm payroll data out in the States, but it's still delayed by 1 week. But instead of that, we're also going to get, we will be getting the ADP data, which is the private sector, private company, the ADP company that does the payroll for a lot of companies. They have their own reading on non-farm employment change, which I'll get onto in a second. But we kick off the day today, Monday. By the way, just to remind you, the clocks have changed, which means that we just have a 4-hour difference between us here in the UK and the rest of and the US, I should say. So Europe and the UK have all changed their clocks and put them back an hour. So the difference between us and the US is just 4 hours. This will only last for 1 week. This coming Sunday, the US carry out their own daylight savings, so the difference between the two time zones will then go back to its usual 5 hours. But for this week, 1 week only, our difference is just 4 hours. So all the data, market opening, etc., we get that influence from the US just that hour earlier now. So it sort of means we tend to see what's going on in the States earlier on for just these 5 days this week. So stock market in the US will open at 1:30 UK time, not 2:30 in the afternoon. So that's that. Let's just look at the data. We've got home sales this week slightly slowing up a little bit in the US, noted last week. So that's something that the market will be watching. We then have retail sales on Tuesday. We're expecting a slight improvement. The core retail sales, rather than the headline retail sales, the core retail sales exclude some volatile food prices. We're expecting a figure of plus 0.4%. And then the consumer confidence at 2 o'clock on Tuesday afternoon. In light of the University of Michigan's reading, this conference board number will be looked at fairly closely. It is a good leading indicator, and looks like confidence is waning in the States, which is perhaps a little bit surprising, bearing in mind the performance of equities that normally sort of encourages consumers to spend as they see their portfolios picking up. But obviously there are other things offsetting that, notably the debacle in Washington, which has not painted the US in a particularly good light globally. ADP employment change, these are the big bits of data coming out this week on Wednesday in the US. As I say, this attracts even more interest this coming week because there is no official data from the Bureau of Labour Statistics. 151,000, it is not good enough. That is not a particularly good number if that comes to pass. The US really needs a number well ahead of 200,000, if not 300,000 jobs created per month. So very, very short of that. Consumer price index as well in the States, out at 12:30. Remember that it is an hour earlier just this week. And then Wednesday evening we have the FOMC statement. So their October meeting, their last meeting in October. Not expecting any change at all there, but it will perhaps it'll be interesting to hear what they have to say about things. I'm not sure. I'm just going to check that they have got a statement. Actually, I've just checked. No change expected. In fact, there is no accompanying press conference, so we're not going to learn anything from this particular meeting, I'm afraid. Interest rate announcements: New Zealand and Japan. Then the main deal for Thursday will be the unemployment claims, which is still distorted a little bit by California, which has still got problems with catching up on the data that they missed due to a glitch there. And California is quite important. It's the most populous state in the US, so that will have an effect on it. 344,000 jobs expected there, nevertheless. Manufacturing PMI in China on Friday morning. That's the official state's reading on manufacturing PMI. And then we finish on Friday afternoon in the US with the ISM manufacturing PMI. So finishing with a fairly important number at 2 o'clock on Friday. It looks as if the market is keen to push ahead on the equity front. This is the headline from Market Watch. Asia stock bounced back from recent declines. Comment in the FT, there is no time to get off the equity train, by John Arthurs, who tends to take the contrarian view, or writes on the contrarian view, but I think there are very few arguments to force people out of equities, but for those of you who are looking for direction, it is a dangerous game to attempt to buck this particular trend for now, certainly. And that's it. Good luck for the coming 2 or 3 days. We reconvene on Thursday morning for a review of the week so far. Thanks very much for listening, and bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.